So I was editing this video and making the thumbnail, and the information I was going to use, I think this gives a lot more information. So you can see what we're going to talk about here. It's pretty insightful, but to compare 2001 with real estate to even 2008, here's the median prices even in LA. As you see, coming in, 2006, it went from 582 to 525 in 07, then 429. And then from here, as the market was crashing, you saw the median price drop. And then it started to come up as real estate recovered. But coming down now, what I'm saying, into 2000, when the stock market again crashed, as we see here, you come back to real estate, the median prices, all they did was actually even just go up year after year. 99, 204, then 227, then 01, 253. As real estate, or as the stock market's dropping, went up another large portion. Even in 03, went up even more and more and more, leading into what we talked about. So enjoy the video.
All right, ladies and gentlemen, I hope you're having a wonderful weekend. I wanted to do a philosophy video, but this just came to my mind. There's so much going on. I thought this was important. I've been working in with a lot of real estate recently, and I think this is an important question a lot of people have. So I want to talk about stocks, but more so give you guys a real estate update on real estate and discuss, what will happen if the stock market crashes or stocks go down, and really what is going to happen to real estate. I gave an update on this a few months ago, actually prior around, I think like July or June in 2018, and there was something unique I pointed out, and even it was expected by the California Association of Realtors, but we're seeing that play out, and we're even getting real estate data come out now for those watching the market and how it's affecting things. So I want to just discuss kind of the price implications of everything. So we're going to go over that. No philosophy video. Drop your thumbs up. But what I can say is thank you all. I appreciate you all. I love everybody on the stream. So we're trading live Monday through Friday, 30 minutes before open, if you did not know that. But you guys are amazing. You kept it on topic this week. Again, we have so much to look forward to. That's why I just, I'm giving you a thank you with more knowledge and information. So hopefully you guys are excited about this, because even though this is real estate, it tells us about stocks. However, those in real estate are involved or even just curious, this is important regardless. So what we're going to begin with, simply come to tradingeconomics.com. If you guys have never been here, you could come up to indicators, select countries, United States, and then go to consumer. Then you scroll down, it'll say housing, and there's a bunch of different data sets here. I have the ones that are most important that we're going to talk about. And again, this data has been released, and the market has reacted at times. There are, stock indexes. There is like IYR, and this is the real estate index, and you see it going down, and you see it going down with the markets. But what I will say, there will be a period where you might see it diverge from the markets, depending on what's happening, even with rates and whatnot. And, we'll discuss that as well, too, because the REITs are... They have a different focus than you would think when it comes to, real estate or how their prices function. So I think the big difference, you guys could even see, January stocks were going up, but the real estate market came down, and then the stocks came down. Which one caused which? Did the stocks catch up? Then they kind of did their thing, but there are a few important data points that we need to point out. So beginning with it, let's see the first one I want to talk about, and I'm going to get to the juicy stuff more towards the middle, but we still need to understand all of this for context. We'll start with the building permits. So this is important because this is letting us know about the supply in the market, but also how investors in real estate are viewing stuff. And now, even if real estate or stocks come down, it affects a different type of people. However, this whole concept of what we're seeing here with what prices are doing now in real estate and what they would do if, or what I'm expecting them to do if we did see the market come down, it's related to this in part. I guess to make it more clear for you and to get to the point of what our initial prediction was, and again, this is the current state of the real estate market. Back around, coming into 2019, the California Association of Realtors, they had a assessment of what they expected, and I agreed with pretty much 80-90% of it to the most part. There was some things I did disagree on, again, considering the climate, and again, at the end of the day, anything I say here, we do not know how it will play out there. We do have historical examples, and we could see the current situation with funding and loans, but we may not be privy to all the information and how, if there was a real big crash, not just a correction or anything like that, it all depends on the level to which assets move. It's hard to predict or to actually quantify or actually say this is exactly going to happen. So just keep that in mind when we're putting all this together. But the assessment was, and if you're in the real estate industry, especially in California and in more higher demand markets, you're definitely aware of this. It's low inventory. Now, I've talked about this being created through Dodd-Frank after the crash. They implemented changes in real estate to make sure we never see that same over leverage that caused a systematic failure that affected Wall Street and it ultimately led to the collapse of some of the oldest banks in the world. By doing this, they raised the lending standards and how banks could give loans and mortgages, and then even the Federal Reserve. So we're going to talk about, because again, this is all related to even bond rates, and we've been making a big deal. This is even related to that as well. But they pretty much raised the standards, changed the real estate, and now even today, that's the argument as to why real estate prices are very, very high, but it's not, even though they're as high or even higher than what they were pre, the crash. It is just not the same leverage. It's not, people don't have 20 houses. It's not the same, risk concentrated or unknown risk. However, there is stuff, we've discussed it, like shadow banking, and again, it's hard to quantify what is the real risk, especially if people are doing risky behavior and concealing it to begin with. But the main point is how it's affected inventory. These new standards have pretty much made it, and this is related to why the prices have gone up and stayed up and keep going up, is supply and demand. There's not a lot of houses now because people did lose all their homes and did that now. But anybody who bought these houses, they're in these homes, or even if you were able to ride it out for the last 10 years, and this was part of the assessment from the CAR, the Association of Realtors, the people who rode it out, or even if they just bought it, the fact is, house prices have gone up because a lot of people don't really want to sell their house because they can't get into another house. So if the houses in your areas are all up 40-50% since the crash, that's awesome. But now, even though your house is up 500, 600 grand, if you wanted to sell it and use that profit to get somewhere, you would be buying a similar type of quality house. You couldn't, or you'd have to go to a better area if you wanted to, take profits and free share your property. But for older people or people whose incomes who've stayed the same, or even if they did make a lot more money and it doesn't meet these, higher standards, they can't qualify for a new loan. So a lot of people aren't selling their house because the question is, what house would they buy? And, it's easier to get a house if the funding's appropriate. And that's going to relate to what we're even seeing now with rates. And for at least those who could qualify, and even, Donald Trump is trying to lower the standards with Dodd-Frank, and we'll see that, again, that could eventually affect it in the future. But there's that aspect of where are you going to move to that's causing this low inventory. But now the people from the last crash, people have held it, and now they're just at these break-even points. Some people who were able to ride it out, they're just at it or just above it. Some people are going to sell, but now even if they do choose to sell, some people will be reluctant to sell. But now once they get to that point and they want to take their money, now it's been 10 years, they could at least get the same amount back. The problem is now with the market slowing down, and that is what we've seen since 2018, and we're going to go through that with the data here. But the problem is, if prices are slowing down now, and more people are start to try to sell their houses, though, a lot of people, again, they're not really going to want to lower the prices. So we're still getting low inventory. It's still low inventory, but even if now what people were worried about with, people wanting to sell more houses and inventory possibly picking up, and this is what the CAR said, it's the weirdest supply. This is all the situation. This is why I'm going over this, has created this weird dynamic in the real estate market. We're seeing that since 2018 till now, and it's playing out, and this is affecting, I think this is going to play into how we see it go in the crash, but it's this weird effect on supply and demand, whereas although inventory and supply could pick up, or even if demand drops, people aren't willing to sell their house for less money. Some either they can't or they're not willing to, and that's what we've kind of saw. So although houses are spending more time on the market and prices may have even came down slightly, the fact is, relative to the inventory coming up or even the drop in demand, you're not seeing prices drop, and that's what people are really worried about, a crash. So with this situation boiling, with the standards how they are, the lack of inventory, everybody needs a place to live. This is affecting it. So again, supply and demand and inventory is probably one of the most important parts. And now it's the things affecting this that, and then it could everything from policy to the actual supply and demand of markets, and now even international buyers and all that, that is affecting what we're seeing with real estate. So this is why the theory was that people were expecting inventory to pick up. People were expecting inventory to pick up and or inventory demand, to drop. However, they were expecting prices to stabilize or stay relatively the same or come down a little, and that's what's happening. People are shocked. They're saying, some of the data is saying pending home sales or this data is down, and it's down this year over year, but the fact is it's still at a really high number. The amount of homes being sold, they're still high, but it's just not growing. But prices are still staying at these levels. They're holding up even despite the negative headwinds like demand or inventory. So that is now the expectation. What's going to happen here if the stock market crashes? How's that going to affect real estate? Well, let's get more into what we're seeing now and talk about that. So now you could get more of the insight, but now this is why we're looking now. We're starting with building permits. This is letting us know supply, and now you're seeing people buy homes and hold it. So now if you're expecting prices to stabilize, there's still people in the market applying for building permits. This is the step to building. You're seeing they're putting in money and they're getting plans. I have a video on the channel. You could see here, my buddy is building a $6 million house in LA, but they've bought the land at such a cheap price. And he said, although cost of materials, and that's even related to the trade war, have gone up, he said they're going to build it. And if they're not going to get the extra money they can, they're just going to hold on and wait because they can. They've got it at a low price, and the asset is still worth money. They're not expecting it to drop substantially, and I think a lot of people are in that same amount. Now, the people who are really getting killed, higher end properties, some more of the luxury markets, or the people that were on the end of buying, in the lower, when we had the low inventory environment, they got caught paying a premium in some of these certain areas, everything, Seattle, Austin, LA, New York, especially, all sorts of places. But we're seeing people still want to build. So you could see, although that's been going up, this is kind of reflecting it, and part of that is rates and future expectations. People wouldn't spend like this, and building permits would drop if people were not expecting anything good to happen. I'm trying to get it. I wish I could zoom in closer, like 2008, so you could kind of see it, but you get the idea. And now it's not as high as it used to be, but in the general scope, people are still building. So that has been a bright spot that people have been focusing on. Here's even the housing starts. You take a look. This is the last year. Obviously, you could even see now, relatively speaking, the market was, people started to get a little worried. 2018 was actually still high. It held up. But after April 2018, it really dropped, and that's when people started to get worrying, especially October 18 and now 2019. The data has been getting worse and worse, but the expectation has been playing out. We're seeing the slowdowns, and we're seeing negative data points, but as far as price, sales, and you're not seeing real estate crash. However, now this is why we're relating it to it. We've seen a lot of stuff happen in October with the stock market. Real estate prices have been nowhere near as volatile. But again, that is the point. The markets do have more leverage than the real estate market does. However, that's, the Fed will come into this when we start talking about rates and, Fed having holdings and stuff, because it's not like there's buybacks in the real estate market, but the Fed does, mortgage-backed securities. That, again, Dodd-Frank and policy. That's why the politics and the macroeconomic stuff, it is important. But that's another thing I probably should have mentioned here. As far as the real estate market goes, this is a domestic market. So trade wars and stuff like that, it can have an effect, but it's like the waterfall effect. And real estate kind of gets hit last as far as the consumer goes. Even if the dollar gets stronger or weaker, at the end of the day, as the consumer, if you own property, the end goal is that if asset prices, well, not necessarily asset, but cost of living, inflation, or even deflation, with the dollar getting stronger or weaker, the house and your living should be a pretty good standard and reflection, at least maintain some of your wealth. So it gets affected last. So even though the trade war affects businesses, how it's going to affect real estate, it's the people who own businesses, and how does that, affect their profits and willingness to invest in real estate, what's going on with their properties, the ability to service real estate debt. And that's the aspect on commercial and all that. And then there's aspect of foreign buyers. So essentially, whether it's affects the movement of the dollar, trade, bonds, anything like that, ultimately real estate is going to get affected last. Again, it's just a more liquid volatile a liquid market. That's why it's less volatile than something like the stock market, which is really liquid. People could pull out money and put money back into it, and even bonds, relatively speaking. Bonds is a liquid market. That's why the bond movements mean more. But real estate is a lot more liquid. It's more of a bigger process. So that's why the trends mean a lot more, but at the same time, it reacts a lot later. So that's why there's either opportunity or, it can even be protection. You have to understand that's why, too, if real estate is expected to do this and keeps maintaining this, although the growth might not be there, it could be a pretty good safe haven depending on how other assets perform. And then again, too, when stuff like the bonds move, which are less liquid than stocks, but more liquid than real estate, that affects now people's ability to borrow and then even willingness. And we'll even see that with the data. But again, here too, this is now the housing starts. So we just saw the permits, and then you're seeing now, although people were getting more and more permits, it was slightly coming down, but still staying up. There was less and less houses starting. And again, you saw that effect as we came into 18, but then 19, there was a bright spot. But then it started to drop, but it's still kind of going here. But again, here's the issue. It's where do we go from here? And again, we're right here at June 2019. So we're halfway through the year so far. So it's held up, but declined in some of that data. But as you can see here, over the 5 years, and this is the point I'm making with the real estate, although there's a lot, it's declining in growth. You compare this now to 2016, and over the years, that's still a lot of houses starting building. People are still going through with the builds, and that's still a lot, especially comparing it to 2014. Now, 2014 to 2015 and 16, this is when we saw bond rates, at a different type of low, and this is when people were getting worried about the real estate market, and the CAR did compare 2014-15 to 2019. We're expecting the same thing because what's happening now happened in 2014-15, and again, 2014-15, we also saw big declines in oils, the first issues with sanctions on Russia. There wasn't a China trade war sanctions or Iran sanctions, but again, all related to oil and that stuff. But that was 2014-15. And as those got really bad and big effects with oil and all that, you saw an effect with real estate. But the market was a lot more vulnerable there coming off of, just 2013. Properties I bought in 2013, even if prices I bought in 2014 went up a lot from there. The market was still cheap and vulnerable. Again, more houses and demand has gone by, but still declining. So now here's the new home sales. So this is already starting on that longer chart. You see how many brand new homes were selling in 2014. It was very, very low. But now compare that right now to 2016 and even 2017. It's gone up a lot. So it's still up. Remember, now look at the 1 year. This was the issue. It was 2018. It was kind of selling, but we saw that drop and it was getting bad, but it's been picking up. But again, historically and over the longer term, that's still a lot of homes and that's still a lot of demand. And again, key here is inventory. But now here's the thing. These are new home sales. So this is where it starts to get a little bit more juicier. This is the pending home sales. So this is where it gets bad. And this is where people are saying it because this is just showing you kind of even – this is pending home sales is any home. So if, again, we've covered this before, but pending home sales is saying how many homes are pretty much in escrow. So that's what we're talking about with a liquidity. It's a lot slower to buy real estate. I go to buy a house. Even if I buy a house cash, the fastest escrow we could have is going to take 3 days, and that usually doesn't happen. You could do 7 days, but typically to be reflective of the most consumer, it's just about 30 days. So pending home sales is letting you know kind of how many homes are in the process of being bought. So as you see here, when the market was going, any of the times the stock market was bad and people were worried, that was U.S. downgrade. The market was bad again. They're still just coming off the recovery. People weren't buying in. That's when it was recovering and people were buying. There's 2012, 2013. There you go, 2014, 15. That's what we saw. But then, coming into 2015, it was good, 16. But it was good in 2016, but as pending home sales started to drop early 17 coming into 18, that's what people were started to worry about the real estate market, but prices and everything kept going up until about April 18 as that trend started to pick up. And we made a video because it started to do it for 1, 2, 3, 4, 5. It had a little break, but 5, 6, right, coming into 18, it was bad coming in the start of 18. The data was pointing at that. But the market didn't collapse. And actually, it just went up and it started to hold up and then gave it, 5, 6 months later. People started to realize it as the market was even coming down even more. But that's where we are now. Pending home sales, they're not dropping as fast, but they're still dropping. Again, October, November, December, then it was bad, but, it slowed down a little here coming into, and again, this is just showing people are still buying homes, but this is also showing you year over year. So this declined in 2018, and that's what's bad about these, because if it's a year over year decline, this is showing you negative 2%. That's from this last year, but that last year was a negative 4%. So that's still down 6% from 2016. So that's April, January, February, March, April. In April, that was off of a 5% from a almost 10% growth. So do you see, you guys, what I'm saying? Putting it into perspective, it's declining in growth, but it's still very high numbers. But again, that's still what we saw in 2014. But this is where it starts to get bad, because this is showing you now demand. So we're seeing now people building, and that's increasing supply, which is it's showing you how people are viewing investment and how people feel about it. But again, too, people are still buying the brand new homes, but we're seeing pending sales drop. And now this is where it gets really bad. Existing sales. So this is homes that are already built. This isn't brand new homes that are getting built related to permits. This is a home. So if it got built in the 80s, 70s, even in 2015, 2017, 18, and it gets sold, that's an existing home. So this is giving you an idea, because more homes than not, there's more existing homes than new homes. So it's pretty much showing you a better scope of the inventory out there. It's mostly existing home sales. So that's why you see this is like 5.4 million versus 700,000 or 673,000 or something along those lines. But existing home sales now. So we'll look on the yearly again. They were coming into January. It didn't, it was doing good, even though we started to see pending home sales have that bad trend. Then it started to hit existing home sales coming October. The same trend you guys see. That's where the concerns with real estate. Then it picked up in 19, but now it's holding. But again, over the 5-year, it's still more existing homes being sold than 2014 and 15 when people were worried again, and you put it on the 10-year, it's still a high number. But again, if that does start to drop, that's what we want to watch. But again, this is showing you demand. Then we got the mortgage rates, but now this is what you guys want to see. Now think about all of this stuff we've been saying. We saw what happened. So take a look. Here's January 2018. So maybe we should come a little bit right before that, because you can see rates went up a little bit. This is what it was 17, and people were worried about the market. They came down a little bit. The market did good, but as the pending home sales started to come down now, remember that's coming into 2018, and then what happened, rates started to go up, and then 2018, remember, we go back, give you guys a bet. Remember, existing home sales, so you guys see what I'm talking about. The homes are coming down a little bit, and again, they're selling, but you can see it's kind of topping out there. There's a little pop-ups and gaps here. We're coming into 2018, a low month in December, pops up in January, February, starts to come down, and we see less and less home sales. This is the mortgage rates now. So it's doing an inverse. As you started to see what happened as the rates went up, existing home sales started to go down. So coming in 2018, we had those little pops. The rates were high, but then they started to come down as rates stayed up, and then rates kept coming in higher and higher. And then literally coming into October, when the market really started to come down, look at what the rates did. They went from 4% to 5%. Then the rates started to come down, and then the stock market went up, but real estate's kind of leveled out a little bit, but it's still back at the 2018 point. But even putting it on the longer term now, compared 2010 to 2014. So again, same thing. We saw we had issues. The rates started to shoot. The rates went up right before leading into 2014, and then we saw some of those issues. Rates went down again. 2014, 2015, the market was concerned. Rates came back down. It recovered a little bit. It did good. Although they popped, they came down pretty much till 2017. They ultimately, despite whatever happened, the trend came down, and it came back to those 2012 levels to allow it to recover. And then market really, really went up. Asset prices are going up. Rates start going up. And then you start to see the mortgage rates come up. And now that's why we're paying attention to this. You guys have been watching the stock market videos and following with this, how the rates are so important. We've talked about the reason why, but now think about the inverse now. Rates go up. As we see here, real estate starts to come down. And again, now the issue is it's more real estate demand, not prices, and it makes sense. It's both mortgage rates, but also there's mortgage rates, the Fed, and other stuff. And again, like I said, it's even an investment for some people. But think about this now. Rates go down. That makes good for real estate. Rates come down. We see the market has done good. Rates go up. That's where we start to see the market panic at those points. That's the real estate market. But now for stocks, we see rates go down. The stock market has been reacting negatively, especially now, because again, this is where it becomes very unique. We look at the rates here on the short term, everything from what the Fed has done to the 1 month and the 3 month, down to now the 2 year and the 5 year. We're at 2.5. Well, right now, they've came down. That was the beginning of the year. It's at 1.9, 10 years at 2.14, the 30 years at 2.58. But that's a lot different than 2014. We were looking at the mortgage rates. That's the 30-year. Again, it was at 3.92. The rate was higher in 2014 as the rate came down. That's what helped ease the real estate stuff. But the difference is now, look at what the 2 year was at. Look at what the 1 month was at. And the 5 year and even the 10 year. The 10 year had the 3 points, but at one point, it started to really come back down to that lower level. But again, here's the 5 year started from 2014. That's when the 5 year started to take off. But I think in 2013, you would be surprised it was below 1%. But now the 2 year as well, it started to take off. I think, pretty much from January. Then the 2 year started to go up by the end of that year. But again, the rates were different. Were very, very different on the short term. That's why now it's affecting the yield curve. But again, rates go down. It's negatively affecting the stocks, and people are worried about what they're expecting now with the future. But it's had a positive effect on real estate. So now the question is, if stocks go down, what will happen to real estate? This is why my assessment, I think it might just stay the same. I think in 2001, and I've said, we're pretty much comparing this stock market crash and real estate crash to 2001 and 2008. So we could even go to the dynamic yield curve to talk about this discussion to see what the stock market did. But in 2001, it was very unique for real estate. Real estate saw a decline in sales. But again, the price sales weren't too bad in 2000, 2001. So anybody out there who was living in 2000, 2001 and investing in real estate, please give your experience below. But again, we saw the effect with rates. Rates were lower, rates went up. Then, the asset prices were high. The short terms went higher than the long term, but asset prices fell before they started to cut rates. Whereas in 2018, they started to cut rates because asset prices were getting too hot. We're kind of at a mix of both of those here with where we're at, but this is where we're at today. So again, are we going to see a 2008 crash or a 2001? I really think it's going to be a mix of both. As far as the market goes, but I think real estate is going to get affected last. I really think if there is going to be a first reaction, I think obviously stocks are going to get affected first is what we've seen, and I think real estate will hold up like it did in 2000 and 2001. However, I think that is if it lasts as quick. The 2001, 2002 crash, you have to really think about it, and this is what a lot of people miss. I have to make a video discussing this, but again, if you see my yield curve video, what happened in 2000, 2001, that was a big crash, a big drop in asset prices, but pretty much only lasted a year or two. And then, what happened in that there led to what happened in 2004. That led to the next bubble. How they fixed the last bubble led to the next one. And that's, again, what I'm saying is different with the rates now from 2008, but we won't get into that. But it didn't last that long. And it started with the stock market. That's why real estate wasn't affected as much, because it didn't last that long. Why did real estate happen here? Because guess what happened? Real estate was dropping in, it was stagnating already in 06, 07, but then 07, 08, real estate was already dying at this point. Then it affected the banks, and that's why the market crashed, because it was real estate first. So in this case, we're seeing the stock market first, then it'll affect the real estate market. But if it's a short, even though it could be a big stock crash, a big drop in stocks, it doesn't have to affect real estate if asset prices don't stay down for that long. That's the only way it's going to hurt the investors with how we're leveraged now, assuming there isn't any shadow banking I'm not accounting for that is destructively over leveraged to the point of systematic failure across the whole entire nation and globe. To help put that into context. But the thing I am saying is that if we do see the stock and asset drop go big, it's a bigger drop and it's bigger than normal and it lasts more than a year or two, the longer it lasts, then it starts to seep into real estate. Just like I was saying in the beginning, real estate's the last to get affected. And that's what I would think if it does come down to it. If people are like, are we going to see the big one? That's what it would take. It would take both stocks crashing, all the leverage and everything getting messed up all the way down to the rates, and how everything and it lasting and not getting fixed for so long, it crashes real estate, and that's the time you've seen it. But other than that, besides '08, why I'm even saying that, real estate it's sustainable, or it's just been a solid investment. Again, even in this marketplace like 2001, people are worried. People are saying, oh, should you buy Bitcoin or gold? Realistically, real estate is the safest thing, as it's been showing with even this theory of what we're talking about with the marketplace and how it's been holding up through all of this. When it comes down to it, real estate is still held up. All my money has been secured in my gains. I've still got the take profit. I'm still collecting rent and yield that is lowering my cost basis year after year. So even if I do have to suffer 1 or 2 years, I already have cushion through the gains and the rent. But even then, I will still collect rent through there. So it's safer than gold. And again, it's a physical property in land, but it grows at a certain higher appreciation rate. And if the market does bounce and they do some stupid anything with rates, lower the standards, and real estate happens to rip, way more growth. And it's not going to have to be Bitcoin or gold or anything like that. It's not going to be as volatile as stocks. So I'm still relatively holding the same. I think we might see a small decline in prices, and that's what I was more bearish on real estate. Although some people said they thought it might go up slightly or stay the same. I thought it would stay the same, or if anything, drop a small percentage, as there is some over leverage and there is some, there will be some panic effect. But overall, I think it'll drop a few percentage points, but it'll be relatively stable. So there's that, a nice long weekend lesson, real estate, stocks, macroeconomics. I hope you guys like it. We are going to be on tomorrow for the watch list. I should be streaming before that. We will see. If anything, though, we are live 30 minutes before open, youtube.com/the stock market. We're going to be trading, you guys. Again, I love you all. Thank you for keeping on topic. Thank you for watching these videos and being interested on it, and put your mind to work. Hopefully you guys can take these thoughts, add to them, contribute, twist them around, make them, let's all learn from this and figure stuff out. I'm just coming up with theories and I'm throwing them out there and I'm sharing them with you guys, and hopefully you guys are learning in the process, seeing where my mind's working, and using your background and skills to elaborate and collaborate off of it and take it to a whole nother level. So I love you guys. I'm gonna see you in the morning. Have a good, safe weekend. Let's go. And hit me up if you guys need to buy or sell a property. I do real estate investments all the time. We got the brokerage. Shout out everybody, TTF Real Estate. You should check out the real estate course. First link in the description. Shameless self-promotion. But let's go.